Options are a very versatile tool that when used correctly can help us to manage our risk and enhance our returns. In this video, I'm going to talk about the strategy called the bull call calendar spread, also known as the poor man's covered call. We first need to understand what is a covered call. A covered call is a strategy where we are selling call options to enhance our return on stocks that we already own while waiting for the stock price to increase to a certain target level. We own the stocks, and at the same time we are selling call options with a strike price that is higher than the current market price. Let's take a look at an example. Let's say on March the 5th, we bought 100 shares of this particular stock at $75 per share, and then we decide on a monthly basis we're going to sell call options to generate a 1% return on our investment. So in the first month, we will be selling a call option with 1 month to expiration at a strike price of $90, and we will collect a premium of $75 for selling this option. The goal here is that as long as the stock price does not increase above the option strike price by the option expiration date, then we will not be obligated to sell our shares. So we continue to do this every month, and every month we will sell call options in order to collect a premium of $75, which is a 1% return on our investment per month, until we reach the month of August, whereby the stock price has increased above the option strike price, and now we are obligated to sell our shares at $100 per share on August 20th. What is the outcome of our investment? We bought the shares at $75 and we are obligated to sell it at $100. So we have made a 33% gain on the shares. On top of that, we have also made an additional 5% return from selling 5 call options over the March to August period, each one of which collecting 1% return per month. And that gives me a total return of 38% on my investment. Now, maybe I look at this setup and I think, ooh, I would love to make this regular stream of monthly income, but I don't have $7,500 to invest in 100 shares of stock. What can I do? Well, one answer to that question is the poor man's covered call. In this situation, instead of buying 100 shares of stock, the alternative will be to buy a call option with a longer expiration time frame. If we go back to our example, on March the 5th, instead of buying 100 shares of the stock at $75 for $7,500, I could instead buy an at-the-money call option with an expiration date of 17 September, which is about 6 months away. And this call option would cost me $1,240. And then what I would do is sell the monthly call options just as I would have done in a covered call scenario, and I would have made the $75 premium every month. This would translate to a 6% monthly return on my $1,240 investment. The official name for this strategy is the bull call calendar spread. It is made up of 2 call options. We will buy 1 call option with a lower strike price and a longer time to expiration. At the same time, we're going to sell another call option with a higher strike price and a much shorter time to expiration. Now, if this trade had worked out successfully, in August, my short call option would have been in the money, and I would have been obligated to sell 100 shares of this stock at $100 per share. In this scenario, I don't have 100 shares of stock to sell. However, because I bought a call option, I have the right to buy shares at $75. If we add up all the premiums that we have collected from selling call options and the profit on the long call option, we get a total profit of $2,120, which is a 170% gain on top of our $1,240 initial investment. So what we see here is that if the trade plays out according to plan, then by using a poor man's covered call, we can actually get a much higher percentage return on our initial investment. In the covered call scenario, I used an investment of $7,500 to make a 38% return. In the poor man's covered call scenario, I used $1,240 initial investment to make a 170% return. And all this with the same movement in the underlying stock price. Wow, sounds great, right? But here's the catch. This kind of trade only works out if everything goes according to plan. The main problem with option contracts is that they are subject to time decay or data decay. And this means that the closer and closer we get to expiration date, the less and less value the option contract is going to have. Now, if things had not gone according to plan, if within the 6 months, the stock price had fallen, or if it had stayed the same or didn't really increase by much, then by the time we reach the expiration date, the call option is going to be practically worthless. The value is going to fall to zero. And I could lose the majority of my $1,240 investment. In this scenario, when the call option expires, it's gone. Poof. Basically, I'll be left with nothing. Whereas if I had bought the shares, even if the value of the shares had fallen, I'm still holding on to shares. I still have them. They still belong to me. The shares don't disappear just because they fall in value. And if I had bought shares of a good business, a strong company, then I know that from time to time, maybe my shares will not perform well in the short term, but in the long term, I know that I have a good chance of recovering this investment because these are shares of a strong, profitable business. And until that happens, it could be months, it could be years, I could still continue to be selling covered calls on a monthly basis. So what does this tell us overall? I think, in my opinion, the bull call calendar spread, the poor man's covered call, whichever you want to call it, it's a good short-term trading strategy. If it works out, there's a good chance that we can make a decent return on a smaller amount of capital. And basically that means that this strategy allows us to take advantage of one of the biggest benefits of using options, which is that it gives us a better efficiency for the use of our capital. But along with the potential for higher returns comes bigger risk. Because of time decay, data decay of option contracts, this trade has to work out within a short span of time, or else the time decay can erode a big portion of the value of the long call. In our example scenario, if this trade had not worked out within 6 months, I basically would have lost the majority of my initial investment. So if I'm going to trade with this strategy, I need to pay very close attention to the movement of the underlying stock on a daily basis. And on top of that, I may need to set a mental stop loss, such that if the value of the long call options were to fall, maybe like even fall by about 10%, for example, just an example, I might want to exit this position altogether, cut my losses early so that I can live to trade another day, find another setup. Alright, so that's all for today's video. Like, comment, subscribe if you found it to be helpful, and I will see you in the next one.